Test. Testing, testing. Okay. All right, folks, we are almost done. So for those of you who haven't been looking at the canvas, so let me tell you what's going to happen over the next 2 to 3 weeks, which is all 3 weeks we have left. So this week is week 11. So today I'm going to try to finish 2 topics, but most likely I'll only finish 1.5. I will cover currency forwards, futures, and using futures to hedge your positions. And then a little bit about currency options and hopefully save that for next week. Next week, I will finish up finish up currency options. But then if I have some time, I will talk a little bit about applications of using options and futures to back out probabilities about how markets thinks about what market beliefs are concerning the probability distribution of possible realization of interest rates or asset prices. So that's kind of something new I'm going to try to introduce to you, following including topics on cryptocurrency. So I feel the need to talk about that topic because most standardized exams in finance now have some section dedicated to that topic. So I feel obligated to talk about it. So that's what I'm going to do this week and next week. And then last week, if there's more things I need to talk about, I'll finish up, any other topics that people want to hear about. Otherwise, I'll spend the entire week of week 3 to go over practice problems together. Okay. And then I will, before week 13, I will give you the list of practice questions to look over, and then we'll just work on it together the entire class for the last week. All right, so that's where we're headed. So today I will go over last week's quiz questions. I gave you 3 quizzes, so I'll walk you through it and then give you the answers. So if you recall from last week, I had 3 questions for you, so I'm going to walk you through it, and then I will go over the case study. Remind you, if you haven't been paying attention to the announcements, I did upload the last and final case study under week 13. So week 13, as you can see, case 2, but it's not due on the last week of class. It is due the week before the end of Saturday before you start having finals. Okay, so just make sure you know the deadline and make sure you realize that it's not due week 13. It's due 1 or 2 weeks. I think 1 week later than that. All right, so I will give you some hints, of course, today, and then hopefully that's sufficient for you guys to work on it without much guidance. So my hope is that it should be very obvious what needs to be done, and force you to think about applying the concepts that you saw in the lectures on something that's, I think, something that's realistic. Okay, so this is an actual thing that happened in Mexico, and I'll talk about it very soon. All right, so let's go over the quiz questions from last week. So last week I gave you 3 questions. This one is a topic on fixed versus floating swaps. So let me read you the question, and then we'll go over the solutions. A borrower with a $4 million floating rate loan pays LIBOR plus 200 basis points on the loan. Payments are semi-annual. The borrower wishes to convert this obligation to a fixed rate loan. The borrower uses a swap with a fixed rate equal to 5.6%. Floating rate is equal to LIBOR, and notional principal equal to $4 million, which of the following most closely approximates the semi-annual payments made by the borrower on the loan of the swap. So the key ideas, I guess, points you should notice for swap contract is, of course, you should pay attention to the notional amount. The notional amount is mentioned here. It's $4 million. And because it's a swap for fixed for floating, we just identify the fixed leg, which is 5.6%, and the floating leg is LIBOR. So we have an original loan, and then there's a conversion from this floating rate, which is LIBOR plus 2%, for fixed, right? So I'll let you think about it. Let me just walk you through it, and then you can stop me if something doesn't make any sense. So our initial loan was the following: we have an outflow of LIBOR, which is a floating rate that banks lend to each other, plus 2%. But we are going to engage in a swap. The swap is going to delete our floating and we will get fixed, right? So we will minus LIBOR for fixed. And our final borrowing rate will be 7.6%, right? So the LIBOR cancels out, right? And all we get is 2% minus plus 5.6%. Okay. So with that in mind, this is our new borrowing rate. Now we have to figure out how to calculate how much we're paying every period, right? So we take 7.6% and we realize this is annualized. Typically, we have annualized interest rates, so we divide by 2. And so our semi-annual payments is 3.8%. And we multiply that 3.8% by the notional amount, which is going to give us 152K. So that's B. Okay. Comments, questions, super easy, right? Number 2. Now this is a little bit tricky. It's a comment, it's a question on duration. So let me read the prompt. A pay floating counterparty and a plain vanilla interest rate swap also holds a long position in a fixed rate bond. So your long fixed bond. So that's the first thing to note. We have a long position. So that means we have an inflow of coupon payments, right? And a final bullet payment at the end. And then we have a pay floating counterparty in a plain vanilla interest rate swap. If the maturity of the bond and swap are both 2 years, the duration of the position will be which of the following? 0, greater than the duration of the bond alone, or less than the duration of the bond but greater than 0. All right, so let me explain step by step what you should be thinking. So first thing, what's duration? It's the time weighted, or well, I guess cash flow weighted time, right? So the proportional amount of cash flow, right, that's going to arrive in 6 months, whatever, every one of those period is going to be weighted by the fraction of that present value with respect to the price of the asset, right? So the trick here is to realize that floating rates move with interest rate changes. So duration of floating rates are less sensitive. So if you recall the duration formula, right? Duration formula looks like this. Duration is equal to, 1% times 1 year plus 2% times 2 years, etc. If it's a purely fixed income, right, then the only thing that moves that's going to screw up your portfolio risk to duration or changes to interest rate fluctuations is from the discount rate. So if discount rates gets larger, for example, that's going to basically destroy most of the value from the future, right? But in the case in which you have a floating rate in which the numerator also changes, then these values also change, right? So if interest rates increases, then actually the numerator actually also increases as well. And that somewhat offsets, right? Somewhat offsets the change in the discount rate. And so intuitively, floating rate bonds should be less sensitive to changes in interest rates. So let me summarize our positions again. So we have a long fixed rate bond. So that means we will be receiving coupon payments. And then we have a pay floating swap, right? So we will, in this case, we will receive fixed, right? And then pay floating. So the way duration is calculated is if you're long, then it's just plus duration. If you are short, it's minus duration. So if you have a long fixed, that's a positive. And then pay floating, that means we have we receive fixed, so plus, and then pay for floating, so minus the duration of the floating part. So let me write duration of fixed minus duration of floating. And because floating is less sensitive, adding these two values, you'll get something greater than the bond alone, right? Because this is less sensitive, so it's a smaller value. So this entire thing is positive. So positive plus a positive is an even bigger number than before. So your duration will be greater than the duration of the bond alone. So the trick here is from here, right? The fact that the duration of the floating is lower, right? Rather than higher. Makes sense. So remember, duration is a proxy for how long it takes for all your money to come. So you're more exposed to duration risk if the duration number is larger, right? Fixed income, most of your money is coming in the future, going as far out into the future. So discount rate changes, you're really screwed. So higher duration means you're more exposed to interest rate fluctuations. But if you have a floating liability, however, that it's much smaller, right? Because you have the numerator of the weights now also fluctuating in response to interest rate changes, right? So a bigger number minus a small number is a big number, or positive number, right? Positive plus positive. So this is the benchmark here, right? Long fixed rate bond. So it's definitely greater than the duration of the bond alone. So the answer is B. All right, final question. A firm that borrows dollars uses dollars and uses plain vanilla currency swap to obtain euros for an investment in Europe is most likely to do which of the following: increase the duration of the position, create a synthetic pay fixed dollar loan, or lower borrowing costs. So it looks to me that it's trying, so nothing to do with pay fixed dollar, synthetic pay fixed dollar loan. We can't really comment on duration either. So I believe what's really happening is trying to lower borrowing costs because it probably has better ability to borrow in a certain currency over the other, which is what it's trying to do, right? So rather, it's not so good at borrowing euros, right? That's what looks like. It's not so good at borrowing euros, so it's borrowing dollars instead, and then engaging in a swap. So this person is trying to, looks like, lower its borrowing costs by borrowing in dollars, right? Right. So that's the takeaway. So you can't really comment on A and B, right? I think those are kind of can't make that conclusions. So the best answer, I believe, is C. All right, so that's it for last week. Let's look at the case study, right? I think this is what everybody wants to know about. All right, so let me give you some hints. So there's going to be some additional definitions I may not have covered in this class, so let me tell you what those definitions are. So this case takes place in the 1980s, so there's a lot of things that may be unusual, or you probably don't see a lot in the news anymore, such as the word LIBOR. So I kind of use this term a lot, but just note that it doesn't exist anymore. LIBOR doesn't exist anymore. And every country has their own interbank lending rates, other than Euribor, which is still legacy. Okay. Um, so collateral, I hope everybody knows what collateral is. It's something you pledge to get, for example, a loan, right? So you can collateralize almost anything, even stock shares. Okay. Zero coupon bonds. We also know what that is. Zero coupon bonds are treasury bonds or any sort of debt that doesn't have cash emissions, right? Doesn't have intermittent cash emissions every 6 months, every year, whatever. So that means that there's only one cash flow. It comes at the end of maturity when the contract is done, right? It's done paying off. Primary market and secondary market. So most likely you heard of these terms in your corporate finance class. So primary market for equity, that's IPOs, right? When a company wants to go public and wants to issue new shares, that they go to the primary market to do that. After the shares has been issued and they're traded with other people beyond the issuer, that's called the secondary market. But these two markets can also exist for debt, for corporate debt, for sovereign debt. There is a primary market in which we have a consortium of banks that that makes bids during bond auctions. So bond auctions is the primary market where the debt is issued to the first people who bid for them. After they've been issued and people start trading them, that's called the secondary market. LIBOR, you know what that is. It's the London Interbank Offer Rate, floating, and it has been the offer rate for, I think more than 50 years, I think. US Treasuries, US Treasury strips. We know what Treasuries are. They're just debt issued by the US government. Strips, on the other hand, might seem foreign to you. So US Treasury strips are US Treasuries, but hedge funds and financial institutions have taken them and split them into two separate financial securities. So US Treasury strips are Treasuries stripped of their coupons, and they're just traded in the secondary market as a separate new contract as a zero coupon bond. Okay. Why is this interesting? Well, people's hedging needs are very diverse, and some people would only want the coupon. Some people only want the coupon, only want the bullet payments. Some people want the whole thing. So the spectrum of investors and their demands is, diverse, and therefore these things exist. But in any case, the strips market is helpful for policymakers because they allow them to actually infer as another data point, right? To kind of evaluate the price of government bonds, right? After removing certain characteristics. All right, so background on case study 2. So this case study takes place in the 1980s, in which we see a lot of funds. Banks received a lot of funds from oil-rich countries and believed that sovereign debt, especially those that are backed by oil, was a safe investment. Now, as you probably already know, based on your observations about the commodity markets, oil is special because it's actually denominated in one single currency, namely the US dollar. So when I say a country's debt is backed by oil, what I really mean is that actually their debt is denominated in US dollars. So you can already see where this case study is going to take you, right? It's going to take you about currency risk when certain countries decide to issue their debts, but not denominated in their own currency, but in foreign currencies. So Mexico borrowed against oil revenues with debt valued with USD. So that means they have inherent intrinsic foreign exchange rate exposure. So let me give you an example of what I mean here. So if there's US inflation or weak USD, this would actually help pay off their debt, right? Because oil prices are really high, and Mexico is an oil producer. They sell lots of oil for really high prices, and they can sell that dollars cheaply sell that money, right? And use that money to service their debt quite easily. But you can now imagine the opposite, right? When there's an oil price collapse. So what happened is there was a oil shock in 1986. Oil shock price led to a collapse of Mexican economy. Why? Low oil prices, strong US dollar, very, very difficult to service US debt. And so what this case study is about, you're a bank, and you're supposed to help you've been called by the US government and whatever to help the Mexican government refinance their debt. Okay, so you're supposed to help them swap out their US denominated debt for new debt that's instead of backed by oil, instead backed by US government debt. Okay. So the key idea here is that high interest rates will make things very difficult for you because that means borrowing rates are very, very high. All right, so that's kind of like the takeaway from this case study. It's very appealing for countries to borrow money with certain currencies other than their own currency. The reason is because they want to raise money from investors from these countries. That's why in Asia, you often see countries raise debts denominated in Japanese yen because they're looking for Japanese investors to put money in there, to lend them money. But you can imagine same thing in the North America region, right? All the Mexican government, Latin American countries, South American countries, they also have incentives to issue debt backed by US dollars because they want investors to come in to give them money and buy their debt. But you can see the intrinsic exposure, right? The fundamental exposure to this kind of risk when you do this, because certain macroeconomic activity that occurs in the US may have secondary effects on your economy. And so you're basically beholden to another country's performance. So here we have, as you know, US experienced high inflation and strengthening of the currencies, and that basically created the 1986 oil shock, right? And therefore, weak peso with high interest rates made refinancing quite difficult. And anyways, that's the takeaway. And the context for, in this case, you're pretending yourselves to be bankers, and you're supposed to help refinance this country. All right, so here are the hints. I don't think I'm going to spend much time telling you, explaining, because I think what I wrote here is quite straightforward. I just want to highlight this part. So question 6b, I will ask you, in the case study, I ask you to construct a term structure. The reason why is because I want you to use the term structure to calculate the value of certain new synthetic, a new asset that you're trying to create, and use that's going to be swapped for the old debt, right? And to evaluate the cash flows, discounted back to time zero, you need to construct a term structure based on the data that's given to you in the case. So in this bullet point, what I'm clarifying here is that you should, in order to construct a term structure, you should just connect the dots. So if the y-axis is interest rates, so I'll just write small r here, okay? And this is the yield to years to maturity, YTM, okay? You read the case study. So read the footnotes, read everything. You will get this information. You will get enough information to construct at least 2 or 3 data points, okay? So with these interest rates plus years to maturity, all I'm asking you to do is to connect the dots, okay? At 6-month intervals, right? Right, so you just use a point slope form. So this is just high school math. I don't expect you to do any more than this, right? This is just a y1 minus y2 equals x. I think, sorry, x2 minus x1, y2 minus y1. Right, point slope form. I think, right, you know what that is, I hope, right? This is just high school algebra. Okay. Right, you can solve for m, right? Just two points, right? So x is referring to time, right? X is referring to this thing, and then y is referring to this, and then you calculate the slope between 2 points, and you just interpolate the points every 6 months, right? So let me know if that doesn't make any sense. But yeah, that's my suggestion to create the term structure. The rest of the stuff is just definitions that I just wanted to clarify. So Please let me know if something doesn't look right before week 13. Okay. All right, so context. Any questions about the context of the case? So I think I gave you more than enough to kind of um, more than enough to motivate why you should care about this case study, right? It's we're talking about FX rates, we're talking about interest rates, we're talking about term structure. This is all finance uh, with some hint of foreign exchange rates, right? Alrighty, so that's the case study. That's my hints. Again, read it on your own. And today's topic, I will go over forward and futures contracts uh, specific to foreign exchange. All right, so forwards and futures, I know this is just review. This is today's class is like 90% review and maybe 10% new stuff. So the new stuff, I'll just tell you what the new stuff is. So I think you know what the definitions of futures and forwards are, because that's what we basically talked about since the beginning of class. It's an exchange that occurs sometime in the future, and that's it, right? It's supposed to eliminate future risk somehow. But as a way to hedge, it can be a little bit more sophisticated than just eliminating future risk. So as I will show you today, if you just use forward and futures contracts from now until the end of the point in time you're actually exposed to the foreign exchange rate risk, then the risk is completely eliminated, right? It's like a blunt tool that wipes out all exposure to that uncertainty. But in today's class, I will tell you that there's a way to unwind your position early if you change your mind. So I'm giving you a little bit more flexibility and giving you another problem to solve from a risk manager's perspective, such that you have a little bit more control over your decisions. So it's not just buying a forward and just holding on to it all the way to the end of your investment horizon. Sometimes you want to be more flexible. You want to cancel out your position, and you can. And I'm going to give you a optimization problem to think about, and then we're going to walk through how to solve for the optimal so-called hedging ratio. And that's going to allow you to decide how much futures you should buy, how much forward or futures contract you should buy or sell to go the opposite direction of your original portfolio position. Right? That's what hedging is. You take the opposite side, but to what extent? Right? That's the fundamental question. To what extent? Do you really want to wipe out all exposure or just some? And that's a decision we can work with later on. All right, so that's our objective, is to review a bit for futures and then talk about using futures contracts to hedge. And it's important to note we don't need to have a futures contract that precisely match the underlying asset. So if I have a portfolio of US dollars, I don't need to work with futures contracts in which there's a delivery or exchange of US dollars or something else. That's not necessary. You just need to find futures or forward contracts that's in which this underlying asset is somewhat related or correlated. And there's a definition I'll get to. All right. So we don't necessarily need to precisely have the underlying asset as a for the forward contracts to properly hedge. It can be a related futures or forward contract. For example, it could be, instead of dollars, it could be Mexican pesos. It's futures on Mexican pesos, which is fine. That's actually fine. There's a criteria we can work with that will tell you how effective our hedging strategy would be, even if it's a poor substitute. All right. So the takeaway and the main broad scope is, we all know what forward and futures contracts are. It's a way to eliminate absolutely all exposure of future risk somehow, if we want to think about from today all the way to the final end of your investment horizon. But today I'm going to try to give you, explain to you that there's more flexibility than that. There's a way to unwind your position, and to hedge, you don't necessarily need to use forward or futures contracts that precisely match what you have in your portfolio. So if you're, for example, if you're trading, I gave you examples with dollars and Mexican pesos. Let's use something else. Let's think about like S&P 500. You don't necessarily need a forward or futures contracts in which the underlying asset that you're you know that it's that you're delivering or whatever is the S&P 500. It can be something else. It can be like the Russell index. It can be uh, some Chinese index. It doesn't matter. Okay. There's a criteria that tells you how effective that futures or forwards contract will be. And we'll get to it once you see the math. You'll see what that criteria is going to be. All right, so let's go over definitions. So again, I apologize if everything's reviewed, but I think it's important to just refresh your memory if you haven't seen it in a while. So terminology, we all know the two sides of a forward contract. When you go long on the forward contract, you're buying or you're receiving the underlying asset. So in this class, we've been working with foreign currency, right, as the underlying asset. And so if we want to write it in terms of payment, that means that you will pay F, so minus F, right? You'll have to pay F for the delivery of the underlying asset sometime in the future. Short means that you're going to deliver or sell, give away the underlying asset in the future, in which case you'll receive plus F. So I'm using F because we're talking about future prices and we're still talking about currencies. So it's important to note, right? I don't have to remind you, forward contracts, not just currencies, can be stocks, can be bonds, can be any sorts of commodity you can imagine, could be coffee beans, can be coconuts, it can be cattle. But pricing forwards and futures contracts is complicated because we are working with so many different types of things that could be the underlying asset or commodity, right? Stocks, bonds, stocks have dividends, bonds have coupon payments and interest payments. Coffee beans, cattle have storage costs. These things could all influence the price of the future contract and will come up, it will show up in the pricing equation. All right. So we give you the structure of the contract. So timing of the cash flow, nothing is exchanged today, no goods delivered today either, but sometime in the future, that's where the things occur, right? It's a bet on what happens in the future. And if the seller, for example, receives the future price, they basically made money if the underlying asset actually dropped in value, right? Because they can probably buy to cover their position, in other words, right? On the other hand, if you're going to be the buyer, you're kind of hoping that the price that you paid is lower than the market price, in which you can turn around and sell. So you can think of forward contracts, therefore, as a hedging tool, or in this case, just a bet about what the future underlying asset value or commodity value will be in the future, right? All right, so what I want to emphasize, however, is despite what position you take for whichever assets, there's a way to unwind your position. So let me show you an example. So suppose we have a contract in which the contract is promised to settle at maturity. So that's the initial contract. You enter a contract, it's going to be settled at maturity. Someone pays F, someone receives F, someone gets the underlying asset, someone delivers the underlying asset. But instead of settling at the maturity, we're going to close the position before the settlement date, original settlement date. So that's the strategy. So let's kind of outline what that looks like in terms of pay numbers. Okay, so suppose Suppose we're going to do the following. We're going to promise to buy $1 in 30 days at t equals 0. And we're going to pay, I'm going to write f underscore 30 to indicate that it's 30 days later, HKD. All right, so talking about Hong Kong dollars, I mean, domestic currencies, Hong Kong dollars, the underlying assets, US dollars. I promise to buy it in 30 days at the price of f underscore 30. But at t equals 29, I'm going to promise to sell that $1 in 1 day for f underscore 1 HKD. So the underscore number denotes the time to the original settlement date. So recap, my initial position was I'm going long on US dollars, meaning I want delivery of dollars and I'm going to pay F for it. But at 1 day before delivery, I'm going to turn around and sell that dollar to somebody else in 1 day. And I'm going to receive F for it. So let me emphasize this is a receiving. So let's do a table. Let's do a payoff table. So today I get in the future, I will get $1 in 30 days, but I will have to pay F underscore 30 HKD. But 1 day before the original settlement date, I will promise somebody to deliver $1, and then I will receive F1 in 1 day. So my final payoff at t equals 30 is simply F1 minus F underscore 1 minus F underscore 30 HKD. So you can already see what futures contracts are if you're not using futures as a hedging device, right? You're not hedging all the way to maturity. You're just taking a side bet and you're just unwinding your position 1 day before, right? This is particularly important because if you just want exposure to future prices of things that are very difficult to deliver, such as cattle, you must remember to unwind your position. Otherwise, you're forced to deliver or receive, right, the cattle at a settlement date. And so unwinding allows you to get that exposure to get that side action on the underlying asset without having to deal with delivering or receiving the commodity or the underlying asset. So here, I don't touch dollars at all, right? The dollars is off my hands at time 30. I just get the difference between these two future prices, F1 minus F30. And F30 is, remind you again, F30 was determined at time 0, but F1 was determined at time 29, right? So this value can settle in cash. So this would be a transfer of F1 minus F30 to long or short position, depending on who's the winner here. So of course, this number could be negative, right? If I am wrong about the value of US dollars, right, increasing in price, then I have to transfer to the other side. If I am correct in that the dollar value in terms of Hong Kong dollars increases, then F1 minus F30 is positive, then I get money. All right, so hopefully that's not too confusing. All right, so let me reemphasize the difference between forward and futures contracts. Forward contracts are traded bilaterally. So that means that there's no central platform in which there's a market maker that matches buyers and sellers, etc. It means that you have to find your own counterparty to make the exchange sometime in the future. And so any credit risk will appear in the forward price, and it all depends on how trustworthy your counterparty is. So it's very likely that your counterparty might just flee, right? Or just refuses to pay. Whereas futures are centralized and standardized contracts, which means that everyone participates in a single platform. And if you want to, in order to continue to remain on the platform, to maintain your position, you have to pledge collateral every time you have to play. Yeah, both sides have to pledge essentially collateral so to prevent each side from fleeing. This is typically called a margin account. So let me tell you what that is with some numbers. So here's an example of the futures market for euros. Okay, so euros price in terms of dollars at time zero. So let's look at time zero. No change in prices. Nobody's gain or losing. And so my current margin account, I believe I am. Let's see. If I go up, yeah, this is going down. So I'm going long euros. Okay, so I'm long euros. Somebody else is short euros, naturally. Okay, and both sides or all participants in the futures markets must pledge some collateral. In this case, $2,000. And typically, there is a threshold in which if the margin account dips below a certain maintenance level, I have to replenish it with more money. All right, so let's look at what happens throughout the 6 days here. So imagine that the price of euros in terms of dollars is 1.33. My marginal account is 2,000. After 1 day, the price of euro drops, right? In other words, the euro gets stronger and the dollar gets weak. The euro gets weaker and the dollar gets stronger, right? And if I'm long euros, that means that I lost. There's a change in price of 0.0006. If you translate that to this amount, this contract size, so this is a contract size of 125,000. So suppose that's what I have. That change in price is a total of $75 in losses. And if you accumulate over these 2 days, it's a minus 75. And so decreasing the marginal account by 25 gives me 1925. That means that $75 was moved from my account to my counterparty's account. And again, I don't know who my counterparty is. It's anonymous. Okay, that's the whole point of futures market. It's everybody. There's a market maker. Everybody matches. Contracts are standardized. I don't know who my counterparty is. It's fine but there's a platform. My counterparty risk is mitigated. All right, let's keep going. 2 days later, prices keeps going down. Dollar keeps getting stronger. Euro keeps getting weaker. I lose a total of 212.50 cents over the last 2 days. And so my margin account keeps decreasing. By T4, you'll see that it has decreased so much that it falls below 1,500, in which I have to replenish it back to 2,000, right? Which is why you see 2,000 here. But after T4, it appears that the prices are going in the direction that's more favorable to me, right? So it looks like prices start going up, 326 to 329, back to 330, in which case the gains and losses are in my favor, in which means that now my counterparty is transferring money to me. All right, so my margin account is now getting bigger. So go ahead and you can do the math yourself, but hopefully my math is correct. So again, the cumulative loss and gain, etc., it's based on the contract size of 120,000 euros, and you just simply multiply that by the change in price here. Yes, multiply by the size of the contract. So that's how the futures market works. different from forward contracts. Forward contracts are bilateral. You have to find your counterparty, different types of risk. But anyways, this is a review, hopefully. Okay, so let's talk about hedging, which is what risk managers care about, right? Most. So let's talk about hedging two types of positions. So hedging typically means that I have a portfolio I have in mind. It can be an overall asset or an overall liability. It means that I expect some inflow of money sometime in the future, or my portfolio is expecting an outflow of money in the future. But there could be risk associated that amplifies my liability or decreases my asset return, right? So there's risk. And now my job is to decide how to use forwards or futures contracts to mitigate or eliminate those possible fluctuations in asset size or liability size of my liabilities. So in this case, when we're talking about an asset, we're talking about a potential inflow of cash, perhaps through a sale of a specific asset. So what I'm going to do is I'm going to break down the hedging into two parts. My original payoff position, what my position looks like when I adjust the future potential price of the underlying asset, and then show you how the hedging payoff structure looks like when I fluctuate the underlying asset price. And then we're going to add those two pieces together and then show our final payoff graph together, okay, with the asset position plus the hedging position. So here an asset means, so asset position means that I'm going long on something and selling it in the future. So suppose I'm going long on the foreign currency, so I'm betting that E will rise, right? So I'm using the same notation from week 1 through week 8 or 9. Okay, so I don't want to use different terminologies from variable names from your other classes, just to be consistent. So if we were to visually look at how our payoff would change when we change what future E might be, we can plot it in such a way in which the y-axis is a payoff function as a function of what future E might be. So I'm going to write E1 to indicate the future value of E. And the x-axis is going to be what future E is going to be. And the origin is going to be E naught. Okay. So when E1 equals E naught, my payout, if I bought it at price $100 and I sell it for $100, then my payoff is 0, right? So when E1 equals E naught, my payoff is 0. So the origin is 0, right? Okay, so what does my payoff function look like when I plot E1 against E1, essentially? It's just a 45-degree line, right? Okay. Right? Very simple because it's a linear, everything's linear, right? I buy something, it increases by 200%, then I can sell it for 200%. Now for the hedging position, I'm going to use F to denote the hedging payoff. It's also going to be a function of the underlying asset, future value of the underlying asset. And the axes are also labeled in the same way. So the x-axis is the future realized price of the underlying asset, and the y-axis is the payoff of my hedging position now, not just my portfolio. Not my portfolio, what I mean. So I'm going to define my hedge in such a way. I'm going to hedge as we all know, you can already see where the risk is coming from. The risk is coming from the fact that E1 can increase and decrease. And I kind of want to eliminate my entire exposure to E1. So my final payoff, when I add G and F together, it should not have E1 anywhere in the equation. That's the final outcome we want. So our hedging payoff should look like the following. Oh, I forgot to write out my payoff. So sorry. Okay. All right. So I hope this is obvious, right? So my payoff of my original portfolio, it's called an asset position because I'm betting that the underlying asset that I'm holding, in this case foreign currency, will increase in value beyond what I bought at time zero. That's why it's a minus E naught. A minus E naught is the purchase price. E1 is the price I get to sell it at one period later. So one period, I'm kind of ambiguous about it. It could be 10 years, it could be 5 years. It doesn't matter. Next, the only period in which you're planning to liquidate. So after one period, I liquidate at E1, and so my final payoff is simply E1 minus E naught. If I want to hedge using futures and forwards contracts, I'm trying to eliminate my source of uncertainty. That uncertainty is coming from here, right? So after adding G and F, my final hedged position should be devoid of any E1s. There should not be any E1s. E naught is determined at time zero. I know E1, and if I do engage in a forward contract, F is also known. So the only source of uncertainty comes from E1, and we want to eliminate it all. Okay. So if we add, so what does this plot look like? It looks like the following. So this is 0, right? Because when F is equal to E1, it is 0. But as F is smaller than E1, then my payoff is going to be, sorry, let's see. If my E1 is bigger than F, then my payoff will be negative, right? In fact, it will be, therefore, on the graph, it will be downward sloping. But if E1 is smaller than F, then I will have positive payoff. So this is upward sloping. So let me label this. This is my portfolio. This is, sorry, let me just say unhedged position, unhedged portfolio. This is my short forward hedge. And so if I were to combine these two positions, this is GE1 plus FE1. We can kind of already know what this is going to look like, right? This is upward sloping, this is downward sloping. So those two slopes should net out to no slope, right? Same thing with here. We have downward sloping, upward sloping, a positive slope, negative slope should cancel everything out. So it should be a flat line. So if I were to label everything here, it could be, the line could either be up here or down here. Okay, something like that, right? Let me, depending on if F minus E naught is positive or F minus E naught is negative. All right, so the takeaway. to recap, we want to know how to use forwards and futures contracts to hedge, that is, eliminate exposure to risk. Where is the risk coming from? The risk is coming from the uncertainty about the value of E1 in the future. If I have an asset position, that means that I'm planning to sell and ask something in the future for hopefully higher value, which is why our payoff function looks like an upward sloping line. As the value increases, I get more money. But that in itself has risk because I don't know what E1 is going to be. So what I can do is I can engage in a futures forward contract, this, I guess, future or forwards contract that tries to eliminate that exposure to E1. So if we don't intend to unwind anytime between 0 to next period, then I can engage in a short forward contract that can precisely eliminate that E1 in my payoff of my portfolio. Why? Because if I were to add these two functions together, G and F, the E1s will cancel out, the minus E1. So all we are left is F, and E naught, right? Positive F and minus E naught. And so depending on whether F minus E naught is positive or negative will tell us if our payoff function is above, the 0 line, right? Whether it's positive or negative. All right. Now the other direction. So if I have a portfolio in which rather than selling something, I am going to buy something to cover my sale today, right? Buy to cover. So in that case, you kind of already can guess what's going to be. It's going to be a long forward hedge, which gives us the precise opposite patterns in both graphs, but then we'll get the same outcome, complete elimination and exposure to E1. So let me just do this quickly because I think this is easy to understand. So liability, short position, we need to buy the cover. So our unhedged position has the following payoff. Sorry, equals E naught minus E1. So here you notice that the variables are reversed because we sold something for E1, which is a positive inflow of cash, but we have to buy to cover our original short, right? So it's a minus E1 sometime in the future. And we're essentially betting that the underlying asset will be cheaper sometime in the future, right? So that we get a positive payoff. But because the terms are reversed, our payoff graph is going to have the opposite slope. So here we have a downward sloping curve. And again, remind you, this is a 0 origin payoff, and it's E naught here, right? When E naught equals E1, the payoff is 0. All right. The long forward, we know it's a upward sloping curve now, but let me be precise. FE1 is going to be defined in the following way: E1 minus F. Why is it this way? Because as a long forward, you're going to be receiving the underlying assets, but you're going to be paying for it using F, right? So there's a minus F, but this is assuming that you're going to turn around and sell E1 on the market, right? Which is why you get a positive sloping curve. So maybe I forgot to mention that in the previous graph. So the reason why the payoff is F minus E1 is because you are delivering and receiving F, but you're going into the markets and trying to buy it cheap, right? That's why it looks like that. So combining these two payoffs, you note that there's a minus E1, positive E1. They cancel out. So if you add these two positions together, GE1 plus FE1, you should get no exposure, right, to any of this. So this is E naught minus F positive, or E naught minus F is negative. So I think this is just all review, right? It's just the insight, right? The insight here is that with forward and futures contracts, you can very, very easily eliminate your exposure to the underlying asset, right? The logic is the following: if you're long something, well, you should think about short forward, right? If you have a long position, you plan to sell something, short forward hedge will eliminate all exposure to it. Very blunt, right? Very blunt hedging strategy here. Here we have a liability position, meaning that we're trying to buy something in the future and we're trying to mitigate that liability. And the intuition is we're going to go the opposite direction, right? We're going to go long forward to offset that bet. And if you do that perfectly, you can eliminate all exposure to E1 in this case too. All right. Summary, right? I kind of already mentioned this already. So assets, sell forward. Liability, buy, right? Because they're the opposite direction, right? Liability, you're betting. Liability is a short position, so you go long. Asset is a long position, so you go short. You have to give up the upside, unfortunately, which is why you see just a flat line, right? There's absolutely no exposure to the underlying asset. Okay, so in reality, when you're a risk manager at a bank or a company, you're not going to you're not really going to hold everything all the way to the end. Okay, most likely you'll be asked to unwind, and you actually maybe be prepared to unwind. Other times you may be required to hedge when there's no comparable assets given your portfolio position. For example, if your portfolio is the S&P 500, or something that looks like the S&P 500 but is not exactly the S&P 500, could you still use futures on S&P 500 to hedge? And the answer is yes. Okay, but you have to calculate correlations, etc. So this is what we're going to dive in right now. So let me introduce to you some definitions, which will make reading the math a little bit easier. So I'm going to define something called the basis. Okay, the basis is the difference between the future price and the spot price at any point in time. Okay, so both futures market and the asset market exist simultaneously. There's going to be a future price and a spot price, and the difference I'm going to call something called the basis. Okay. So the basis return, I'm going to reference that as B. Let me use proper mathematical notation here. So the basis return, I'm going to define it in such a way: R B T equals to BT minus BT minus 1, and I'm going to scale it by ET minus 1. So I want you to think about this return, okay? It's not really a return. It's just a placeholder to reference this expression. Okay, but I'm just going to call it a return because that's what everyone says it in the textbook in the industry. The basis return is the difference between today's basis and the previous basis divided by previous period's asset price. Not really a return because not really a return in the strictest sense, because usually we would put BT minus one in the denominator, but I'm not, right? But that's how we define basis return. The return of the underlying asset, we all know what that is, right? It's just the percent change in E over one period. So that's RE. Okay. RE is just the simple return of the underlying asset. Great. Final thing I want to define is, let's see, RFT. RFT is the future price today minus the future price the previous period and divided by the previous period's underlying asset. Again, note that the denominator is not FT minus one, it's ET minus one. You should just think of this as placeholders, and sometimes it's called future pseudo return. But in any case, this is just a placeholder so that when we do these calculations, it's easy to refer, to mention, okay? All right, comments, questions? All right, so let me give you the setup of the problem, and then I'm going to bring up another set of slides from the summary slides. So this is what's called the minimum variance hedging portfolio. And I'm going to just solve for the long position first. And meaning that I'm expecting a sale of the underlying asset as opposed to a purchase of the underlying asset sometime in the future. So let's assume that I have a portfolio that I plan to sell, and the value of my portfolio when I decide to liquidate one period later is going to be E times N, where N is the number of units of the underlying asset times the price, right? So if I have 5 million US dollars, I want to sell it for Hong Kong dollars, then it's the Hong Kong dollar price for US dollar times the number of dollars, right? So it's ET times N. But we learned from the example in the beginning of class that two things, right? Number one, futures contracts allow us to mitigate our exposure to the underlying risk of future ET. But we also want to be able to unwind, right? So let's assume that we're going to unwind our position in one period too. So we know that for a long position, we're going to go short forward. Short forward means that we're going to receive FT plus one, FT minus one. So let's assume that we engage in the futures contract one period before. That's why it's a minus FT minus one. But we're going to unwind our position one period after. So in T minus one, I'm short forward, and time T, I'm going to long forward, which is why you see a minus FT here. Okay, does this make sense? So let me recap. Let me recap. We want to identify, our objective here is to set up a problem to solve mathematically so that we can decide how much we need to buy in terms of futures or forwards, or sell in terms of futures and forwards, so that we can minimize our exposure to future fluctuations of E, right? That's the whole point of today, right? Those graphs I showed you, we know that if we do everything to the end with zero unwinding, we can eliminate all exposure of fluctuations of the underlying asset. But this is a little bit more subtle. I'm allowing myself to unwind now, right? So I'm now writing the payoff of my portfolio if I plan to liquidate my position one period later, while allowing myself to hedge in the period before. So we learned from those, we learned from the graphs, right, in a few slides earlier. If we have an asset position, which means that we're going to sell something, we need to go long forward in the previous period, which is why you see a minus sign. Two minuses plus, right? So we receive FT minus 1, right? And multiply it by M, which is the number of units of the forward contract that you're going to sell, right? Short forward, right? But if we're going to unwind our position, we need to cancel out that initial F, right? So we're going to, rather than short forward, we're going to long forward, which means we're going to be paying F today, right? Today being the day we're going to unwind our position and sell our assets, which is why you see a minus FT here. So factoring out the minus, right, you get minus quantity FT minus 1. N denotes the number of shares of the underlying number of units of the underlying asset that I own that I plan to liquidate at time T. And M is the number of units of forward or futures contracts that I'm going to buy or sell or unwind, right, at time T2. So the question is, what proportion of M and T should I choose such that the variance or the standard deviation or whatever, your metric of risk, is minimized, right? So we'll just think about variance here, okay? Simple, right? All right, so I skipped a lot of steps here, so I'm gonna move to my other set of slides, which should give you, let's see if I, all right, here. So how do you reduce this equation into something that looks like a ratio, a hedging ratio? I'm gonna just walk you through the steps to set up the question, right? And then I think solving it and simplifying it is tedious. I'll give you the final result, but if you prove it, I'll leave it as an exercise if you prove it yourself, okay? So this is our initial, this is our, where we left off, right? I explained to you what this is. This is your portfolio value if you decide to liquidate at time T, and allowing yourself to hedge in the previous period and unwind your futures or forward contracts in this period. So that's why you see a minus quantity FT minus 1. The trick here to make things look better, I mean, more readable, is to plus ET plus DT minus 1 and minus ET minus 1. So to this equation here, I'm going to plus ET, gotta use this. I'm going to plus E 1 minus ET 1. And let's put an N there. Oh, let's put an N at the end. So this is what I'm doing. Okay. So that's essentially adding 0, right? I'm just adding 0 to this equation. So adding 0 to that equation, I can start moving things around. So I have this term. We already have this term here. That's this term here. So that's this term. But I am now combining this term with this term. which means that I can factor out the n, which is why you see the n here. And then this is the same, right? This last expression hasn't changed yet. The next step, I'm going to factor out n from the last two expressions here. So n comes out, but h is defined as m over n, right? So if I factor out the n, I now have a h parameter, which stands for hedge. Why? Because it's literally the hedging ratio, right? You're looking for the proportion of the asset value, or units of the asset, sorry, the number of units with the numerator being the number of forward contracts that you plan to buy to hedge against the underlying asset. And the last step, I'm going to divide everything by ET minus 1. Okay. Divide everywhere ET minus 1. So the return of my hedged portfolio is RHT, value minus ET. And notice that this is the return of the underlying asset, ET minus 1 divided by ET minus 1. And FT minus 1 divided by ET minus 1, that's the pseudo future return, right? So everything comes in now. Let me know if I lost anybody in that derivation. All right. So this may look complicated, but note that we don't care about what return HT looks like, right? Because at the end of the day, we're hedging, we're risk managers, we want to minimize risk. We're not maximizing things, we're minimizing exposure. We're trying to eliminate exposure to something. So we can focus on the variance because that's a key measure of risk. And we're going to take the variance of this expression here. And we know that if we take the variance of some expression that adds constants, those constants become irrelevant because the variance of a constant is 0, right? And so our variance expression therefore just reduces to this term here, right? We can just focus on this term here. So minimizing the variance of RHT is the same thing as minimizing the variance of RET minus H RFT. Agree? Because n is just a constant, so it doesn't vary, right? Variance of a constant is 0. And then variance of something, a constant times random variables, we can just focus on where the random variation is coming from. And so the variance of ET minus HRF is the same thing as the variance of RHT, right? Cool, right? And then if you know how the properties of variance, we know that if we have linear combinations like this, we can write it as a quadratic expression, meaning that if there's a factor here, we square it, right? And then we have a covariance term here. So just based on that property of variance, we can easily minimize that because it's, again, as I said, it's quadratic. So there's concavity or convexity, right? It's a, yeah, there's a hump, right? It's a hump shape. So calculus 101, how do you find the minimum of a quadratic? You just solve for the first order condition and set that expression to 0, right? And you solve for the term that allows you to achieve a slope of equal to 0. So let me write that down. Take First order condition set to 0, solve for h. We want to find the h that allows us to find the minimum point of this quadratic expression for variance. And if you solve it, you should get precisely this. I'll leave that as an exercise, but I think that exercise is easy. All right, so maybe you don't think of this as very cool, but what I think is cool is the fact that this expression h star equals covariance of RE, RF, and the variance of RF. If you think carefully, this solution looks very much like a regression coefficient. You agree? Because if you recall your econometrics 101, how is beta defined? Beta is defined as the slope term based on this econometric model, right? So beta is h here, right? H precisely is your coefficient of interest in your regression. So if you were a risk manager and you just want a very simplified, find the optimal hedging ratio that minimizes the variance of a long asset position, just run the regression. Regress the return of asset prices on the pseudo future return, and you can get H star econometric. Don't have to work through all this math. Okay. All right, so the next step is more of the selection of RF, okay? So actually, if you just want to find the H star, the optimal hedging ratio, we're done, okay? You have this equation here. You're fine. If you have H star, you can solve for it this way, or you can run a regression, which will allow you to identify what H should be, right? It's just a slope coefficient from a standard ordinary least squares regression. But things get complicated if you have a spectrum of what RF you should be choosing, right? So if you can't find an RF that's the same underlying asset as your investment portfolio, because your investment portfolio is super diversified, then we have to think about properties of RF, right? Such that allows us to achieve, something closer to, as low as a variance as possible, right? So let's plug H star back into this equation. So let's plug this expression back into here. So substitute H star into your original objective function. I'm not going to do it by hand. Just prove it to yourself, okay? You plug H star into this original objective function, you will get this expression here. You might think that this is a lot of numbers, a lot of expressions, but I'm going to tell you what this tells you, okay? So I already told you before what RB is. RB is defined as the difference between the future and spot price, and to calculate the basis return, it's the difference between basis today and yesterday divided by the spot price yesterday. Okay. And so the row term, notice the row term, and notice the basis term. These two terms you can't do anything about. Okay. So whatever the return is for E, it is what it is. Whatever the return for F, can't do anything about it because it's in the denominator. Because I guess you can make it really volatile, right? But that doesn't really help, I think, intuitively. So we focus on these two other parameters, RB and rho squared, or the correlation coefficient. Okay. So rho EB is the correlation coefficient between the spot price and the basis. So just looking at these two parameters, there's basically two ways you can get zero volatility, right? If you find a basis that's very, very stable, basically a constant, then the variance of the basis return will be zero, right? And so if you think about it, I should be looking for a forward price. Doesn't matter, it doesn't have to be the same asset, it can be a completely different asset, underlying asset. As long as the basis is very, very stable, then it could be give me something very, very close to a perfect hedge. That's one way. The other way is if the basis is perfectly correlated with the spot price. So that's the correlation coefficient rho EB. If the basis is perfectly correlated with the spot price, which means the rho number is the rho variable here. So 1 minus 1 will give me 0. So empirically, this is never the case. Okay. It's almost impossible to find a basis that is perfectly correlated with the spot price. The reason is because the basis is typically not a function of the fundamental value of your asset holdings. Assuming your assets is foreign currencies or S&P 500 index or whatever, any equity based, it's unlikely that your correlation coefficient will be anywhere close to equal to 1. In other words, unrelated is what I'm saying. What you should focus on, just a rule of thumb, is trying to find a set of forwards or futures contracts that has a basis return with zero volatility, or as low of a volatility as possible. And that's kind of your best bet to get a hedge close to zero. All right, so let me recap a bit. We set up our original objective function. It's the payout function of our hedged long position, right? An asset position. We rearrange some terms such that we can focus on specific returns to minimize the variance of those returns. Because as risk managers, we're not trying to maximize returns. We're not thinking about trade-offs. We're trying to identify the risks that we want to stay away from. So we're only minimizing the variance, and we solve for the optimization problem because we realize that the variance of a linear combination of terms gives us a quadratic objective function, and we solve for the optimal hedging ratio. That's what this is, right? And we realize that H is the beta coefficient, the regression coefficient when we regress the underlying asset return on the future return. And depending on what you choose as the futures or forward contract to use to hedge, it's very easy to calculate H star, right? Just run the regression, just run OLS. But the hard part is identifying which F to use, right? If you can't find the exact underlying asset to hedge, what else can you choose? Well, you should think about two things. As we substitute H star back into our original objective function, we notice that there's two components of the equation that we can think about: the variance of the basis return or the correlation coefficient of the basis return and the return of our underlying asset. And just a rule of thumb, finding a rho squared term that's close to 1 is almost impossible. And actually, it should be very close to 0 in most cases. What you should think about is actually finding a basis return in which its volatility is very close to 0, or as low as possible, right? As low as possible. All right. So here I used to derive it by hand, but I realized that it will take a long time. So I'll leave that as an exercise for you to solve for H star and solve for this, okay? Or rearrange the terms to make it look like this. It's not important, but the derivation, that if you're curious how do you arrive at that, I leave, it's just algebra, okay? All right, so comments, questions on hedging with futures and forwards. So let me recap a bit before I talk about, I'll talk about this after the break, but let me just recap what we learned today for futures and forwards. So futures and forwards, I think it's nothing special because we learned about it in the beginning class and you probably had some exposure to it last semester. And we learned that you can think of it in terms of a side bet, right? But that's not the complete picture because yes, indeed it's a side bet, but if you combine that side bet with a position, like an initial position, such as a long or short position, it can help you eliminate exposure to the underlying asset fluctuation, right? The key takeaway was that if you have a long position, you go short forward. If you are a liability position, you should go the opposite to buy forward. So the point of going through these pictures is to demonstrate just how blunt the tool is. If you time your asset return precisely with your forward contracts, and the forward contract expires or matures precisely at the end of your investment horizon in which you liquidate your position. But that's not realistic, right? Realistically, you need more flexibility in your risk management. You want to be able to unwind. So here I give you a more flexible model in which you focus on deciding what the optimal hedging ratio should be. The hedging ratio is defined as the fraction of units of the underlying asset that you want to short forward or long forward to offset your long or asset liability position. We define an objective function. I define an objective function for you. So this is for the long position. You can redo it in the short position too. For the long position, we did some fancy algebraic manipulation, and we identified an objective function to minimize the variance, and we solve for the optimal hedging ratio, right? H star. And our first conclusion was that very, very easy to solve if we can run regressions, right? If you've already identified the futures and forward contracts, you just run the regression on the asset return on the pseudo future return. Solve for beta, you have the optimal hedging ratio. The second insight, however, is that it's not always possible to find exactly the futures and forward contracts to match what you have in your portfolio. So you have a choice of which futures or forward contracts to engage in. And the choice, therefore, based on this expanded objective function in which we substitute H star back into the variance, we notice that we can choose a forward contract in which the basis return is stable, or we can choose a forward contract in which the rho, the correlation coefficient of the basis return and the asset return is very, very correlated, right? It's equal to 1. And yeah, those are your two choices. So that's up to the choice of the risk manager, okay? And the rule of thumb I give you is in your research, you will most likely find that the correlation coefficient is rarely anywhere close to 1. And your best bet to finding a good hedge is finding a basis return that's close, that has very low volatility. All right, so let's take a 10-minute break, and then I will finish hedging with futures and forwards by talking about the future spot parity, which you may have seen in your other class, and show you that it's the same thing as CIP. Hopefully not surprisingly, that you probably had a hint of that. And then I will talk about yeah, I'll talk about the future spot parity a little bit, and then finish with options. Okay, or I try to do as much as options before the end of class. All right, see you guys in 10 minutes. No quiz again.
1点，1点。
All right, everyone. Let's finish up futures. So the equation for the futures, the put spot parity, the future spot parity, you must have seen in your other class last semester. So I'm writing it up here. Hopefully it's not too unfamiliar. It's written in the second bullet point here. All right. I believe in your futures class, you probably don't have these parameters here. You probably don't have S or C, right? I think it's just R minus D. But we've expanded the futures equation, futures spot future equation here to account for the fact that sometimes the underlying asset is not just stocks and bonds. A lot of times it also involves commodities as well as foreign currencies. And so therefore the model has expanded with additional parameters, but I think the intuition remains the same. Sometimes this model, the future spot parity, is called the cost of carry model because the future price can be interpreted as the opportunity cost of not having to deliver the asset today. Okay. In which case, any sort of benefits that you accrue from holding onto the asset from today all the way to the future date, that's not ultimately not going to be passed on to the buyer, right? And so any sort of benefits or convenience, the counterparty is not going to pay for it, right? In which case, it should not be incorporated into the final futures price, which is why you see minus D, a minus sign in front of the D, right? So intuition, if it's a cost that you can pass on to your counterparty, it's going to be a positive parameter. So if the cost of borrowing money to buy the asset and carrying it all the way to maturity is very, very large, that should be reflected in the R. So a bigger R will inflate the F price. But if we're talking about stocks and interest payments, that's going to be captured by D, because of stocks and bonds, you're not responsible to deliver dividend payments. You're not responsible for delivering coupon payments. Those benefits, they're not going to pay for. They're just buying for the bond to be delivered at that time without any of those benefits from holding on to the asset. In which case you see a minus sign for D and also a minus sign for C. So C is a convenience yield, meaning it's an expression to capture all sorts of benefits as an interest rate. Okay, so it's also a minus sign for C as well as for D. The last term you see is S. S stands for storage cost, and it's positive as I explained earlier. If it's a cost that the short position has to bear all the way to maturity, they're going to try to pass it on to the counterparty. So if the asset or commodity in this case is very expensive to store, such as gold or cattle, you have to feed the cattle, keep them alive. Well, that storage cost must be transferred to the counterparty. They have to pay for it, right? Otherwise, as we all learned from, as you all must learn before in the last semester, there's going to be arbitrage, right? But that's the intuition. It's called a cost of carry because any sorts of cost that that's part of the holding onto the asset until delivery or commodity has to be transferred to the counterparty, and that's going to be reflected in the futures price. However, that also means any sort of benefits that you accrue from holding onto the asset must also be accounted for as well. They're not going to pay for the dividend payments. They're not going to pay for the interest payments. And so those things have to be removed from the cost of carry. All right, so that's the intuition. What does this have to do with foreign currencies? Well, foreign currencies also earn interest on dividends, right? So D here is just R star, right? For currency exchange, for FX rates, right? For currencies, foreign currencies, it's just, instead of D and interest payments, we're talking about R star. And so what I'm going to show you eventually is that this cost of carry model precisely translates to covered interest rate parity, which is something we've worked with since week 2 or 3, right? So let's go ahead and walk through the proof, and then you'll hopefully see the parallels immediately. So consider the following trading strategy. So what I'm going to do is I'm going to sell forward a contract at the price of F. This initiation is typically called the cashing because I'm creating a future cash flow, right? Out of nothing. It costs nothing to engage in a future contract, but I've already created a future cash flow, right, out of thin air. But of course, this can't be possible. There must be some sort of costs associated with creating this cash flow. And so you'll easily see what I'm going to do. So once I create this short forward position, I'm going to borrow some amount of money, ET, which is the price of the underlying bond, until settlement at the rate of R, which means that I have to pay 1 plus R at settlement date. I'm going to take that amount of money and buy a bond for the price of E. This is called a carry. Okay, it's called a carrying because I bought the bond today and I'm holding it on to it until settlement, in which I have to make the exchange. So at settlement, there's two outflows or inflows of there's two sources of cash flows, right? There's an outflow. I have to pay for the price that I pay for the bond plus interest. So that's ET plus times R, right? That's total outflow. That's the principal amount times 1 plus R. And the total proceeds is the cashing, which is the cash inflow created from shorting the underlying asset, plus any coupon payments that I may accrue from holding onto the asset, right? So if the bond is principal value of ET and there's coupon payment C, then I will receive E times ET, let's just say 1 period, okay? E times ET. So total profits is total proceeds minus total outlay. Total profits, I just replace these 2 bullet points down here. And in equilibrium, you can't have positive profits, otherwise there's arbitrage, right? So it has to be equal to 0. And if we set our inflows and outflows equal to 0, we find that our final expression for the future price must be equal to the following. This looks very familiar to the cost of carry model because it's just a periodic return, right? It's just 1 plus r minus c, but that reflects the continuous compounding nature, right? With the exponential here, right? We still have a positive r, but we have a minus d here, or sorry, minus c here. We have the same thing here, right? R minus c. So any sort of convenience that we get from holding onto the asset, it's going to reduce the value of the future price. Whereas if the cost of borrowing is really high, then F is going to also increase. Make sense? So that's the intuition. That's the essential proof of the cost of carry model. What does it have to do with CIP or UIP in this case? All right, so consider the following cash and carry model, but now instead of bonds, let's work with foreign exchange rates. So here I'm going to sell forward for a cashing of 1 plus R star times F. Okay, so 1 plus R star times F. So I expect a inflow of 1 plus R star times F, but that means I have to deliver some amount of foreign currency sometime in the future. I'm going to borrow again, just like in the previous example, ET until settlement date, in which case I have to return principal plus interest rate, right? So I'm going to take that ET by 1 unit of foreign currency and then carry it all the way to maturity. And I will be able to earn R star in the meantime, right? So that's the benefit from carrying foreign currencies. So looking at the different types of cash flows, we have an inflow of 1 plus R star times F because I've earned I've earned R star for carrying the asset. Plus, I will have, yes, so that's F times R star plus the delivery of F. The outlay is ET plus ET times R. So that's just the amount that I borrowed, right? So if I combine these two proceeds and outlays, my profit equation will look like this. In equilibrium, it has to equal to 0, otherwise arbitrage. So if I rearrange the terms, you'll see that FT will be equal to ET times 1 plus R divided by 1 plus R star. And moving this R star to the other side, you'll see that it is precisely CIP. So now you see the connection. If you have taken derivatives class, you've actually already taken FX exchange rate determination, right? All I've done is basically give you the intuition and how that links to the macroeconomy and so forth, but it's no different, right? It's no different than what you learned in the past. All right. So I think I've already highlighted the intuition of interpreting the parameters of the future spot parity, right? If it's a benefit, it needs to be subtracted. If it's a cost, it needs to be added. Storage cost is an adding. If you interpret all these costs in terms of interest rates, right? It's an adding of interest rates. If it's a convenience, it must be subtracted. All right. So some terminology when it comes to the cost of carry model. So you've probably heard of the phrase positive carry or negative carry. So these terms refer to how convenient or inconvenient it is to carry the underlying asset all the way to settlement. So when something has positive carry, that means the benefits exceeds the cost of borrowing, in which case the future value will be traded at a discount. Makes sense? Because there's so much convenience from holding onto the asset, it's going to deflate E all the way to a much lower level than the spot price. Very convenient to hold, right? Very convenient to hold. Makes sense, right? Because if there's a lot of convenience, minus D is big, minus C is big. So a very negative number, right? Plus a positive number is still negative. So there's a deflationary effect occurring to E, in which case F is also lower. Negative carry refers to how costly it is to hold, right? Because if convenience and dividends are like 0, but the cost of borrowing is really high, then we're going to have to inflate E, right, to make it worth their while to carry the asset or commodity all the way to maturity. settlement, right? So just terminology. So if you hear the phrase positive carry, it just means F is less than spot price E. If it's negative carry, future price is higher than spot pricing. And okay, the last thing I want to talk about for futures and forwards is what's called contango and normal backwardation. So this is very hard to explain because there's disagreements over what exactly normal backwardation and contango means to different people. So what I just described to you, negative carry, positive carry, some people interpret it as normal backwardation and contango. But if you want to be precise, according to academics, it's not, the spot price is not necessarily equal to the expected value. So to be precise, normal backwardation refers to the fact that the future price is trading at some value less than the expected value of the future spot price. So E brackets means expected value, means taking an average of what people believe this future spot price will be in the future at capital T. Contango is the opposite, where FT is greater than expectations of the future spot rate in the future. So how do you remember the difference? Well, the way I remember it is the following, highlighted in this bullet point. It's called normal because typically we think that ET is risky, right? If ET is risky, then we expect that something that's a known, something that's without risk should have lower mean, right? So F is something that's devoid of risk, whereas ET has risk. So the average return on F, or the average value, should be lower because there's no systemic risk or systematic risk, right? So we expect F to be less than expectation of ET. Contango is the opposite, so that's kind of how you remember it. Well, if you watch the news, they usually use these terms to refer the path of the future price with respect to how E evolves over time. So if you kind of suppose this line is like a representation of, ET, then normal backwardation refers to the fact that the F line is approaching ET from below. So this is no, I was and contango is the opposite, right? So I'm gonna double check that that's exactly what I wrote here. Okay. All right. Despite all of this, in reality, despite what I say here, okay, in reality, what's more common is actually this. Because most commodities are very, very expensive to deliver. And so we expect the future price to be much higher than the spot price, even if you think about it in terms of expectations. So if you look across the spectrum of the futures markets, what is more typical is actually contango as opposed to normal backwardation. Okay. It would be abnormal to see normal backwardation for, cattle or oranges, coffee beans, etc. All right, comments, questions. So the last two things I talked about was just understanding different terminologies. If you observe F is greater than E, spot price E, the higher it's negative carry, expensive to deliver. If F is less than E, very convenient to deliver. But when we're talking about expectations of E instead of just E itself, spot price E, we have different terminology. But overall, this is supposed to describe the nature in which the future price converges to the future spot price. So if it's converging from above, it's contango. If it's converging from the bottom, it's normal backwardation. All right, comments, questions on, so that concludes my discussion on futures and forwards in this class. All right, if no other comments, then let me begin currency options. Now, I'm not going to devote any of my time deriving Black-Scholes or doing simulations because I think you're going to do that in your other classes. My job is just to show you how to hedge currencies with options and maybe how to use options to kind of forecast or to kind of extract what markets believe how assets evolve over time. So you can come up with a probability distribution based on options, as you'll see maybe next week. So my job is to show you how to use options to hedge, to pinpoint exact exposure to certain price beliefs about where the price should be, the future price should be, and tell you how the Black-Scholes model is somewhat, how it's different, given that we're talking about foreign exchange rates as opposed to stocks and bonds. But you kind of already know, right? The Black-Scholes you learned must have had a dividend parameter, right? If there's a dividend parameter, then that's basically where our R star comes in, right? So we'll get there next week. But my task today is just to go over how to use options to hedge, again, different positions that you have. Again, similarly, like I did with the futures and forwards, we're going to see how to hedge given an asset position and how to hedge given a liability position. And then I'm just going to go really fast on the definition of an options contract. All right, so big picture. I don't know if this is discussed in your other classes. Option pricing is basically generalized asset pricing. The reason because is in asset pricing, we typically think about buying and selling portfolios and then hedging by buying and selling something else. Your cash flows are proportional to the amount of units of assets that you're holding, right? Units of stocks, units of bonds, units of currencies. But option pricing, it's not longer a linear payoff anymore. Right? Do you agree? I think that's obvious if you've taken derivatives because you can see that the payoff function for options has a max function in it. There's a discontinuity, right? It's not continuous. There's a fundamental break in which you decide to exercise or you don't decide to exercise. And therefore your payoff is not, it's a kink, right? You just look at the payoff function. It's a kink, it's nonlinear. And with nonlinear payoffs, you can no longer use discount rates in the same way. You can't discount things like DCF anymore. DCF is only if your cash flows is, it's linear, right? Your cash flow payments are linear. But with options, your cash flow is nonlinear. And therefore, your discount, you can't use one single discount factor to discount your cash flows. The big picture idea that won the Nobel Prize is with option pricing that you're learning in the derivatives class, your discount factor is contingent in the state that you are, right? Whether you're up, whether you have a high stock return or a low stock return, right? High stock price or low price, you have essentially a different discount factor to discount the payoffs, right? Back to time zero, right? That's the big picture of option pricing. Make sense? So that's why it's so complicated. compared to just forward contracts, swaps, bonds, stocks. You need a model that, so in other words, CAPM definitely does not work to price options. You cannot use Black-Scholes to price, sorry, capital asset pricing model to price options, because options is one single discount factor and your payoffs are all linear. But as we all know, options contracts, nonlinear payoffs contingent on the state in which you are, right? Whether the stock is high, whether the stock is low. And therefore, you have a different discount rate for each state of the world. So that's the big picture. So I hope that joggled your memory from your previous semester. All right. So let's just dive into the definition so we all know what that is. So an option is a security that enables you to pay, that you pay some price, and then you have the option to exercise sometime in the future, either to buy or to sell. That option could cost something today, so it's different than forward contracts, right? Forward contracts, you pay nothing, swaps, you pay nothing. Options can cost something today. And there is an expiration in which you can exercise either at maturity or before maturity. But for this class, we're just going to be working with the standard Black-Scholes definition, in which you can only exercise at maturity. You cannot exercise before. American options, no, as far as I know, there's no closed form solution, and you need to simulate, you need to run Monte Carlo simulations to price it. I could do that, but I feel like that's a bit too much. But anyways, our class, exercise date occurs, option to exercise occurs at the expiration date. Okay. So let me go through the parameters I will be using. Terminology, right? So E, we still have E as the underlying asset. It's a foreign currency, has a price, domestic currency price, E. The price, the asset is a foreign currency. Option price is either C or P. So C for the price of call option. I'll tell you what a call option is later, if you don't know what it is. P for put. And of course, the strike price. This is why we have a kink in our payoff, right? Because we have a strike price that tells us whether or not we decide to exercise or not. So if it's a call option, it's the right to buy at this specific price. If it's a put option, it's the right to sell at this specific strike price. And when the underlying asset is equal to the strike price, that's called at the money. If it's a call option, it's so-called in the money if the underlying asset exceeds the strike price. So for call, E is greater than K. For put, it's K is greater than E. And out of the money if it's violated, right? Hopefully that's intuitive, right? In the money, if I hypothetically could exercise today, I would have a positive payoff. So maybe I should clarify, because I guess I didn't talk about it yet. So the payoff function looks like this. For calls, at maturity, my payoff would look like this. For puts, it would be this. So maybe I write a capital T to indicate that it's at maturity. So given these definitions, as long as ET is greater than K, I will exercise, and therefore I will get a payoff at ET minus K. If otherwise, if I decide to exercise, I would lose money. So my payoff would be to be zero because I would not exercise. Put is the other way around. So I would only exercise if the underlying asset price falls below K, because that's my right to sell at K. Otherwise, my payoff is zero. which, right? So in the money for call is ET greater than K. In the money for put is K is greater than E. If it's out of the money, my hypothetical payoff would be 0, because if I were to exercise, I would get a negative payoff. All right, so let's talk about the visual representation of call options and put option payoffs. So let me put the payoff function here. And so in this class, I'm not going to ask you to price anything. If there is a price, it will be given to you. Okay. Your objective is just to use your understanding of the payoff functions to construct a desired payoff function of your portfolio that matches your risk preference, right? As a risk manager, whatever that is. One way to visualize the payoff is using what's called a payoff table. So let's maybe do that first before drawing anything. So let's look at the payoff at time t equals 0. Look at the payoff of ET less than K. I highlight the whole thing. Cool. Okay. And then K is less than T. So what am I doing? I'm looking at my payoff at time capital T, depending if the underlying asset is below or above my strike price K. So for long call options, that is the right but not the obligation to buy something at price K, right? And I'm hoping that the underlying asset value will exceed K, so I can turn around and sell the asset I just bought for price of K. So time T equals 0, I will have to pay for the call option. So that's minus C. If the underlying asset value at maturity is less than my strike price, I would not exercise. So my payoff is 0. Whereas my payoff would be ET minus K if it exceeds my strike price. So graphically, ignoring the cost of the call option, my payoff would look like this. So this is payoff. This is E capital T. My payoff would be 0 if ET is less than K, but it would be positively sloping if ET is greater than K. So I hope you've seen this graph before, right now. So you can see that it's nonlinear, right? It's nonlinear. So cannot price. You basically, what I'm saying is you have to price the option with a different discount factor here and a different discount factor here. But anyways. So if you want to incorporate the call option price, we can. It's just a downward shift of the curve, right? We shift it down by C. It's a minus C. Of course, this is not accounting for, this interest rates, right? I'm just assuming that the C cost is paid up front and it doesn't accumulate any interest payments, okay? So just minus C, shift down. So call option really has value if the payoff exceeds the cost of the option in the beginning up to out here, right? But you have downside protection. You cannot lose more than C. Again, my job is just to highlight the intuition of what this contract entails. Short call. Short call just means rather than it's just the call option, but you are writing the call option yourself. You are not the call option is not like being traded. You're just creating the call option yourself and hoping somebody buys it. And if they buy it, you're essentially taking the opposite position as the person who bought it from you. So the trigger event still works the same way, right? Because if ET is greater than K, the person who bought the call option will exercise, in which there's a negative payout, right? There's a payout coming from you to them. Otherwise, you get to keep the sale, the revenue you get from selling the call option. That's why the price is a negative. It's minus C because you get money from selling it. But the gross payoff, including the exercise of the person who has the option, is just minus the call option payoff, right? It's the same max ET minus K, but now there's a minus sign because you have to pay out when it's exercised. So if we were to do this diagram in both using tables and both plots, we can. Let's do it. Let's do a table. Cool. Payoff at time t equals 0, ET less than K, and K less than ET. And so the payoff is now positive, right? Because I sold the call option. But the difference is rather than getting money when the underlying asset price exceeds the strike, I'm losing money when the underlying asset exceeds the strike. So it's a minus ET minus K, which is just K minus ET, right? So let's plot it. Payoff. ET. So without accounting for the revenue I get from selling options, the payoff would look like this, right? 0 if it's less than K, so it's K. 0 payoff. Otherwise, I lose money, right? So that's infinite downside. But if we want to account for the C, that's easy. It's just the upward shift of my payoff function by C. Sorry. There we go. This is plus C. So this graph tells you two things, right? Number one, my upside is capped, right? I can only get up to C, but I have some protection, right? If the asset price falls, exceeds K, sorry, if the asset price exceeds K, I have some protection. In fact, I can still end up having a positive payoff if it doesn't exceed K by too much. But of course, after beyond that threshold here, right, it's infinite downside. All right, so that's call options. So the question you may ask is, when would you engage in a short call? When should you engage in a short call or a long call? I'll save that perhaps for next week. Let's just go over long put and short put. Okay. So long put. Oh, they already have the graph. Long put. So long put means that you're betting that the underlying asset falls below K, right? The strike price K. And so if you're long, that means you're hoping that this max function gives you some value that's positive, right? And that's only if ET is small. This contract costs money, costs P. It will cost you P. So let's do a table, a diagram. Payoff at time equals 0, ET less than K, K is less than T. So it will cost you P. So it's a minus P. My payoff, if ET falls below strike price, is to exercise because my payoff will be positive. Otherwise, I will not exercise. Drawing the graph should be intuitive enough. If I'm betting that the underlying asset falls in value, and that's where I get positive payoff, then I should have a downward sloping curve here to the left of the origin. If the origin is K, this is ET. This is payoff. And 0 otherwise because I would not exercise. Accounting for the cost of the put, it's a downward shift of the payoff function to here. So this gap here is minus P. So again, similar to the other graphs, this should tell you I'm betting on large swings in the price. If the price falls by a lot, it will offset the price of the put option. But my downside is limited by just the price of the call option because it's stuck here, right? Short put is just selling the put option and hoping that the person that bought your put doesn't exercise, right? So everything is just reversed. So my short put payoff is minus max K minus ET 0. Diagram or table. Payoff at time t equals 0. K is ET. That should be a positive P because I sold it to somebody. And if ET is less than K, the person who owns the option that I sold will exercise. And therefore, my payoff is the negative version of that. So that's minus K minus ET, which is equal to ET minus K. And 0 otherwise. Payoff F ET K. So ignoring the profit that I get, my payoff function would be the following. To the right of the origin, it would be 0 payoff, but this would be an upward sloping curve if E falls below K. And then if you want to account for the price, it's just an upward shift. This is plus P. Okay, intuition. The shorting of put gives you a cap on your upside at plus P, there is some downside protection here. If the asset value drops below K, but not by a lot, right? You still can get a positive profit, but your downside is unbounded if ET drops to 0, right? All right. So with those tools in mind, we can now think about hedging. And again, we split hedging into two different criterias. Whether you have an asset position or whether you have a liability position. So we already know this, right? This is the forward contract. If you want to hedge any drop in value whatsoever, you have to give up all upside if you decide to sell forward, right? That's what we concluded from beginning of this class. So long an asset, sell forward. For liability, we have to give up upside as well. And you take the opposite effect. So this is a short position. You go long forward, but you're giving up all exposure to the underlying asset. And so you get no upside and downside. But with call options and put options, we can be a little more precise in what we want to be exposed to. So if you have an asset position and you want to protect yourself from large drops in value and you don't want to give up your upside, you would engage in a long put. So we'll see that in a few slides. Small drop in value. If you want to be protected against small drops in value and also give up your upside, you would sell calls. Large increase in value. Without giving up upside, you would buy a call, and small increase in value, you would sell put. So let's try to do a couple of things. So I think we still have some time, so let's go over. Hedging against large drops in value without giving up upside. So large drops in value, that's this one, without giving up upside. So we're going to focus on this first. Okay. So we have an asset position, which means something like this, right? Payoff function looks like this. And we're going to buy put. Put, we know what that looks like, right? And then we're going to see what all that stuff looks like mashed together. So to keep the graph readable, I'm going to assume that the strike price is equal to the spot price. Okay. Make a table here, 2, 3. Cool. All right. So payoff at time t equals 0, ET less than K, K is less than T. So if we are long underlying assets, we must have purchased the asset price today. So our payoff at time 0, therefore, would be minus ET. Agree? So now we're accounting for the cost of initiating a long position. We have to buy it today, so it's a minus ET. In the future, because it's unprotected, unhedged, we will obviously get a payoff of ET, no matter what, right? We sell it, we get ET. The strike price is irrelevant to us because we are unhedged. If we want to protect ourselves against large drops in value, what we're going to do is we're going to buy a put. So I'm going to pay P today. And that will give us a payoff of K minus T because the underlying asset value is below the strike price. And we would not exercise otherwise because we would otherwise get a negative payoff. So our final total payoff is minus P minus ET today, but our payoff combined is K for ET less than K and just ET, right? Why? Because I am just right doing a total here, right? I'm just adding. So let's plot this. So you can kind of already see how it protects you against large drops in value without giving up upside because you have this exposure here, right? All right, so let's plot it. So our unhedged position looks like this, right? It's just upward sloping. I'm just gonna write K equals ET here. And ET. This is gonna be combined with a long put. So let me write long put. We know what that is. It's like this. So I'm just looking at the final payoff. Okay, we're not accounting for the initial costs. This is ET. This is K equals E underscore T. Oh, sorry, it's long put. Sorry, that's the other way around. My bad. That's a long call. It should be like this. Yeah. Right. Long put, you're betting that ET, E capital T falls below K. If it falls below K, I will make money because my payoff would be K minus ET. So that's why it's positive here. But if it's below K, if it's above K, I would not exercise, so my payoff is 0. So if we add things together, the intuition is the following. This is downward sloping. This is upward sloping. So we should get a flat line, but we still have upside here, right? Because this is a flat line plus a positive sloping line. So we have upside still. So our final payoff should look like this. That. So maybe draw it closer to the. No, this is not accounting for the initial cost, but accounting for the initial cost, it will be down here and upward sloping. So this is minus P. And yeah, this is minus P. And this origin here is K equals ET. I won't write it, but this is ET. All right, so large drops in value, right? So if there's large drops in value, you're protected, obviously, because it's a flat line here. Right? So it's as if you own a call option, right? Essentially. And you can see we didn't give up upside because we have an upward sloping curve here. And so if you have an asset and you just want to be protected against large drops in values, then the long put can be good for you. Right? Because you just want to protect yourself from the possibility that you just lose everything, right? The most you can lose is just minus P, right? In this scenario. But you still retain positive upside if there's, if you believe that if you believe there's a chance, right, you might have a really large ET. All right, the last thing I want to go over before today's end is hedging against large increase in value when we have a liability position. Okay, so let me write this is asset position. And here we have liability. And again, I'm going to assume that K equals ET, just because the graph looks better this way. So let's go ahead and do this. Payoff at time t equals 0, ET less than K, and K less than ET. If we are liability, that means we must have sold something today and have to buy it back one period from now. So that means we have a cash inflow of ET, but in the future, we must pay ET, E capital T, right? So it's a minus ET, regardless of whether or not the underlying asset's above or above K, below or above K. Now, to hedge against a liability position against large increase in value, that's this point here, we're going to buy a call, which means that we're going to pay for the price of call option and only exercise if ET is greater than K. And we can calculate the final total cost or benefit minus E capital T and then minus K. So note that everything's negative here, which is interesting. So given this, can someone tell me whether this should be positive or negative? The payoff at time 0, should it be positive or negative, given that my payoff is always negative, no matter how ET is realized, E capital T is realized? It should be obvious. Anyone? Positive, right? It must be positive. Otherwise, it doesn't make any sense. You would pay for something that always pays, that you always lose money. Doesn't make any sense. It has to be positive. So this is like a typical MBA style question that you could get, I don't know, in the future to determine whether or not, yeah. Otherwise, you can also say it violates law of one price, right? Okay. Let's finish up. So lot-wise, we know what the unhedged position looks like. It's a downward sloping position. This is ET. I want to write again, K equals ET at the origin. Plus my hedging position. It's a long call. So that means it looks like this, right? This is again ET, then K equals T, E small t. And you can already kind of guess what's going to happen, right? The positive sloping, downward sloping curve is going to cancel each other out. You get a flat line, but you get a upward sloping here, upside, right? Unlimited up, still get upside on the left side of the graph. So add these two plots together, you should get precisely that. you get this is something here. This is without considering the benefit of selling a call option. Sorry, buying a call option. Let's see. I mean this is minus C because it's positive, right? This is minus K. Yeah. So note that this is positive, right? Which means the graph shifts upwards, right? So you have a short position, long call shifts the graph upwards because it's a positive value. You see that you still retain the upside, but then you have hedging on the downside here, right? Otherwise, you have unbounded here, or large losses are possible. All right, so I will continue the rest next week. Yeah, so I know this is boring, but I will try to introduce some new stuff next week when we try to back out uh, probability distributions of asset price realization in the future using options. I think that's a little bit more interesting than this. Okay, so I hope I gave you enough hints for the case study for you guys to complete it. But if you have questions, just ask. Anytime until week 13. Okay. All right. See you guys next week.